Okay, in this section we're going to learn how to account for the purchase of inventory items from suppliers, and this includes purchase returns, purchase allowances, and also purchase discounts. The first thing we're going to talk about is recording a cash purchase of 2 picture frames at $6 each, so a total of $12. The entry is very simple. As you see here, we're just going to debit inventory, the 12, and then we're going to credit cash, 12. We also need to know how to record the purchase of the picture frames on account. And as the note here says, purchased on account means that the company did not pay cash at purchase, but received the items on credit extended by the supplier. So this does not mean that we paid with a credit card at all. What it means is that when we purchased the items, we either picked them up at a location or they were shipped to us, but no cash traded hands at that time, and the supplier was able to extend us credit, and they're going to send us a bill for the items. Maybe it'll be due in 30 days. But that is what we mean by purchased on account. So the entry is very simple. We're going to debit inventory $12, and instead of crediting cash, we're going to credit this accounts payable account. And that is a liability account, so that means that is an amount that we owe to a supplier. Now, one of the things that might happen is we may want to go ahead and return one of the picture frames. So the entry for that is very simple. Each of the picture frames was $6, so if we're returning one of them, all we have to do is debit accounts payable for $6 and then credit inventory for $6. So accounts payable, the liability that we had to the supplier, which was originally $12, it's being reduced by $6, so now we only owe the supplier $6. And the inventory account, originally it went up by 12. Now it's going down by 6. So now we only have inventory from this original purchase of $6. Something else that can happen is that we can receive what's called an allowance from the supplier. And in this case, we're saying one of the picture frames was actually the wrong color. So maybe we wanted a red one, they gave us a blue one, and we don't want to return it. We'll still sell the blue one, but we could use a $2 allowance from the supplier. So as the note here says, an allowance is a price reduction, which is an incentive to keep unsatisfactory goods. And as shown in the previous slide, this item, or these 2 picture frames actually, were originally purchased on account, meaning credit was extended, we didn't pay cash at the time of purchase. So recording this $2 allowance is very simple. All we have to do, as you see here, is debit accounts payable, the $2, and then also credit the inventory account, $2. So accounts payable, the liability, is actually going down $2, and also inventory, the asset account, is going down $2 for this allowance. Now, what we're concerned with here is how do we account for an early payment on an invoice? So what's happening is originally a purchase was made for inventory items on account, meaning no cash was exchanged at that time, and the supplier sent us a bill. Maybe they said we had 30 days to pay, but they also said if we pay early, maybe within 10 days, we'll get a 3% discount. And so in this case, if the original purchase was $12 and we actually paid within the 10 days, we get the 3% discount, which is 36 cents. This is going to be called a purchase discount for the early payment. Here we see the journal entry in the top box of this early payment, and also the associated discount that we got when we paid within those 10 days. So there at the top, January 8th, accounts payable was debited $12. The cash we paid was only the $11.64, so we credit cash $11.64. And then we also credit inventory for the 36 cents. That was the discount, the 3% discount. And at the bottom, we can remember that original entry that we made when we purchased the items on account. We debited inventory $12 and we credited accounts payable $12. So at the time, we weren't sure if we were going to pay within the 10 days or if we were going to wait 30 days. So we had inventory at 12. Well, notice with the entry we're making upon cash payment up here, we're subtracting inventory 36 cents. We're deducting from the $12. We're taking away 36 cents. So now the net amount of inventory that we have on the books actually equals the cash payment, $11.64, which is what we would expect.